Hi. So today I'm gonna be telling you about what is cryptocurrency trading. So first, cryptocurrency trading is the act of speculating on cryptocurrency price movements via a CFD trading account or buying and selling the underlying coins via an exchange. CFD trading on cryptocurrencies. CFDs trading are derivatives which enables you to speculate and cryptocurrency price movements without taking ownership of underlying coins. You can go long by if you think a cryptocurrency will rise in value, or short sell if you think it will fall. Both are leveraged products, meaning you only need to put up a small deposit known as margin. To gain full exposure to the underlying market, your profit or loss are still calculated according to the full size of your position, so leverage will magnify both profits and losses. Buying and selling cryptocurrencies via an exchange. When you buy cryptocurrencies via an exchange, you purchase the coins themselves. You will need to create you will need to create an exchange account, put up the full value of the asset to open a position, and store the cryptocurrency tokens in your own wallet until you are ready to sell. Buying and selling cryptocurrencies via an exchange. When you buy cryptocurrencies via an exchange, you purchase the coins themselves. You will need to create an exchange account, put up the full value of the asset to open a position, and store the cryptocurrency tokens in your own wallet until you are ready to sell. Exchanges brings their own steep learning curves as you will need to get to grips with the technology involved and learn how to make sense of the data. Many exchanges also have limits on how much you can deposit, while accounts can be very expensive to maintain. How do cryptocurrency markets work? Cryptocurrency markets are decentralized, which means they are not issued or backed by a central authority, such as a government. Instead, they run across a network of computers. However, cryptocurrencies can be bought and sold via exchanges and stored in wallets. Unlike traditional currencies, cryptocurrencies exist only as a shared digit product record of ownership stored on a blockchain. When users wants to send cryptocurrency units to another user, they send it to that user's digital wallet. The transaction is not considered final until it has been verified and added to the blockchain. Through a process called mining. This is also how new cryptocurrency tokens are usually created. What is blockchain? A blockchain is a shared digital register of recorded data. For cryptocurrencies, this is the transaction history for every unit of the cryptocurrency, which shows how ownership has changed over time. Blockchain works by recording transactions in blocks, with new blocks added at the front of the chain. Blockchain technology has unique security features that normal computer files do not have. Network consensus. A blockchain file is always stored on multiple computers across a network rather than in a single location and is usually readable by everyone within the network. This makes it both transparent and very difficult to alter, with no one weak point vulnerable to hacks or human or software error. Cryptography. Blocks are linked together by cryptography, complex mathematics, and computer science. Any attempt to alter data disrupts the cryptographic links between blocks and can quickly be identified as fraudulent by computers in the network. What is cryptocurrency mining? Cryptocurrency mining is the process by which recent cryptocurrency transactions are checked and new blocks are added to the check blockchain. Checking transactions, creating a new block. The miner consolidates recent cryptocurrency transaction into a block. The block is cryptographically secured and linked to the existing blockchain. The miner earns a block reward which they can inject directly back into the market.